Hi, welcome back to this my final session on value investing. But let's see where we are in this process. After I introduced value investing by talking about Ben Graham and Warren Buffett, we looked at screening, looking for low PE, low price to book, high dividend yield stocks, and how that has performed over time in terms of delivering excess returns. We turn to contrarian value investing, where you buy stocks after a price drop, but where the fundamentals have to suggest the value is still holding up. We talked about activist value investing, where you come into a company that you think is not just undervalued, but poorly managed and change the way it's run. In this, my final session, I want to talk about looking at value investing in the aggregate, both in its glory days of the 20th century and in the 21st century where it struggled. Look at whether in fact it was as glorious as it was made out to be during the glory days and why it's struggling now. So let's set the table. Let's start by looking at by decade the returns to PE and price to book, traditional screens for value investing. In each of the decades, I've looked at the lowest price to book stocks and the highest price to book stocks, the annual returns, and put the difference. And as you can see, in the last 3 decades, in two of the three, 1990 through 99 and 2010 to 2019, value investing, at least in its traditional form, low PE, low price to book, has underperformed high price earnings and high price to book. We'll file that away. You could argue that it's just a temporary phase, but that's a long period, 30 years where value investing has struggled. But if you were to look across time, it's true, value investing looks like it delivered higher returns than growth investing, at least with very generic screens. So I want to take a closer look at the 20th century, at those glory days, so to speak, where low price to earnings and low price to book stocks did better than high price earnings and high price to book stocks. And I'm going to make two arguments. Even in those glory days, there were periods where value investing underperformed. And even in those glory days, active value investing, we actually went out and did research and found undervalued companies, didn't actually deliver much value. Of course, in recent years, all of these screens have kind of fallen off. I want to look at why that might have happened and what value investing might need to do to kind of rediscover itself. It's a lot on the plate, so let's start by looking at value investing versus growth investing by year. In the previous tables and graphs, we looked at value investing in the aggregate. Here, I've looked at the lowest versus highest decile of price to book stocks by year going back to 1927. And we look across time, you can see there are good years and bad years. And in the 93 years of data that I have in this graph, in 93 years, low price to book wins, but in 44, the high price to book stocks portfolio wins. So even though on average, in the aggregate, low price to book stocks earned higher returns than high price to book stocks, it's almost 50-50 in terms of a year-to-year basis. If you have a 1-year time horizon and you thought value investing was going to deliver you excess returns and you bought low price to book stocks, half the time you'd have been disappointed. If you dig a little deeper and look at active value investing, where you actually go out and do research and look at the management and assess the value of the company, there's remarkably little evidence that that has actually created value in terms of higher returns. And the question is, if value investing is just coming from buying low price earnings and low price to book stocks, in what sense is it value investing? Because there's nothing you're doing as a value investor that's adding to the game. There are two pieces of research that I'm going to use to back up the proposition that active value investing, where you go out and do research, hasn't historically paid off. The first is by looking at institutional investors who classify themselves as value funds or growth funds. Instead of comparing these funds to the S&P 500, where the value funds will start with an advantage simply because of the history of low price to book stocks, I've compared value funds to an index fund of value stocks. We just buy low price to book stocks, and a growth fund with an index fund of growth stocks, high price earnings, high price to book stocks. Effectively, what I'm saying or looking for is, what is the value added by looking at investing in an active value fund, a fund that goes out and says, we're going to look for cheap companies, as opposed to just buying a value index fund. And the evidence, and this is where it's one slice of history, it could be different in different slices, suggests that in terms of value added, Value funds actually add less value than growth funds. In other words, activeness in value funds actually makes your returns worse than just buying a value index fund. With growth funds, activeness adds value. There's something that growth investors do that can add value. That's not great news if you're a value investor, because it suggests that research has a bigger payoff in growth stocks than in value stocks. One slice of history, you're saying, what about individuals? Maybe institutions are not that good at value investing. Here, the evidence is a little better. On average, active individual value investors still underperform by about 1%. And it's heavily skewed. The very top quintile outperforms the market by about 6%. So there's an element of hope here, right? If you're an individual investor, you believe in value, you do research, and in the top quartile, you outperform the market by about 6%. And if you look a little deeper at these winners, there tends to be more home bias. You stay close to the things you know, and the portfolios are concentrated. And the more you trade, the lower your returns become. So individuals do a little better than institutions in terms of creating value from research. But on average, they too underperform the market. But if you're a really good individual investor, maybe there's hope. And that was in the good days. They're saying, what about activists, value investors? On average, they've added value, and you saw that with the excess returns over time. But on average, if you look across time, those returns have drifted down. As private equity has become bigger, it's attracted more capital, more average investors. The returns are very volatile on a year-to-year basis, and they're very skewed. The biggest winners account for much of the excess returns. So if you were to look at the evidence in activist value investing, if you were invested in the very best activist value funds, you were beating the market. Keyword is were. But you might no longer be, as the business has matured and drawn in more capital. So even in its glory days, on a year-to-year basis, the value outperformance was volatile. Active value investing did not add much value, either at the institutional level or the individual level. And the bottom line is we're entering into a new century where even the traditional value investing ways of making excess returns, the old screens, don't seem to be working. As you saw, low price earning stocks, low price to book stocks, at least in the last 10 years, the last 15 years, have underperformed the market. And value investors are facing an existential question. Have things changed so much that you need to move on, find different ways of investing? Or is this too something that shall pass? There are many value investors who hold on to hope that this is a passing phase, that they can go back to buying low PE stocks and low price to book stocks and earn returns. Some blame central banks for their problems. Others argue it's index funds that have caused the problems. They're looking for excuses, essentially, that tell them this too shall pass. But at least some value investors are starting to re-examine what they do. So maybe there's something about the traditional way of thinking about value investing that is no longer working. And I have something to add to that discussion. You might not like what I have to say, especially if you're an old-time value investor, but I have to speak my heart. I think value investing has lost its way. It's lost its way because it's become rigid. Things you can do and things you're not supposed to do. Classifying investors as shallow or as good investors, it's become rigid. It's very ritualistic. There are things you're supposed to do as a value investor. Pay heed to the Schiller P, talk about Warren Buffett, view everything he says as effectively the truth. It's rigid, it's ritualistic, and it's very righteous. Righteous in what sense? Old-time value investors seem to think that they're entitled to a reward. Why? Because they've done the right things, they've gone to the right places, they've done the right research. And when you're righteous and you don't get your returns, you start to get frustrated and angry, and you take it out on the market. Value investing has become rigid, it's become ritualistic, it's become righteous, and in the process, it's become a place where it's very difficult to create change. I think of myself as a value investor, but not in the traditional sense. Here are some things I think we need to open the door to as value investors to do it better. First, if you're a value investor, let's talk about value. Much of value investing as practiced today is a screening, low PE, low price to book. In what sense is that value? You're not valuing companies. You're not growth and the risk. In fact, I am surprised at how much pushback I get from value investors when I talk about intrinsic valuation. Those are estimates, it's speculation. If you are unwilling to actually value companies, I don't see how you can use the word value investor to describe what you do. You can't view discounted cash flow valuation as an academic exercise. You have to get your hands dirty and actually value companies. And you have to be clear about the difference between value and price. Price is driven by demand and supply, value by cash flows, growth and risk, and what the difference is. Second, you can't stay in the Ben Graham mode of avoiding uncertainty. I can understand why Ben Graham did it. He came out of the Great Depression, and to him, this was the key, to avoid taking risk. But if you avoid taking risk, it has consequences. You're going to end up, in terms of the life cycle, with mature and declining companies in your business. You will never buy great young growth companies, even if they're undervalued. If you truly are a value investor, why wouldn't you find undervalued stocks which are young growth companies if you can value them right? Avoiding uncertainty can't become the end game. You can't avoid it. Third, a lot of value investors talk about the margin of safety as their alternative to traditional risk and return models. I've heard value investors say, I don't like betas, I don't like portfolio theory, I like the margin of safety. I think you're missing the point. Think of what the margin of safety is. You first value an asset and then put in a margin of safety, 20 or 25%. You buy a stock only if the price is X% lower than the value. I can understand why you do it, because you could be wrong about your value and markets might not correct. But to use the margin of safety, you first need to value an asset. And to value an asset, you still need a measure of risk. Whether it's beta or arbitrage pricing model or some other proxy, margin of safety is an add-on. It's not a substitute for risk and return models, because you need those to value an asset. And when you do pick a margin of safety, using a higher margin of safety is not necessarily a good thing, because there's a trade-off, and here's the trade-off. It goes back to something we talk about in statistics, type 1 versus type 2 errors. If you set your margin of safety higher, you've avoided one type of mistake, right? You're avoiding those overvalued stocks that you might buy because you made a mistake. But you create a second type of error, which is you might not be buying some undervalued stocks because you set the margin of safety too high. So if you set your margin of safety at 50%, it's true, you will not be buying an overvalued stock by mistake, but it's also true you might not be buying a lot of undervalued stocks because you set the margin of safety too high. You're saying, how would I know if my margin of safety is too high? There's a very simple metric to use. Look at your portfolio. If half your portfolio is in cash, your margin of safety is way too high. You need to bring it down because you're not finding enough to invest in. So margin of safety is a measure you can use, but it's a luxury measure, a measure that works when you have hundreds of opportunities in the market and you can take only a subset of those opportunities. Fourth piece of advice, don't take accounting at face value. I've said some mean things about accountants, and I won't take them back. Accountants are not always consistent in the way they estimate things. So traditional value investing is so wedded to balance sheet and income statement numbers that when accountants screw up, they take along value investors for the ride. There's a reason I'm not a great believer in book value of equity or book value of capital, because those are accounting numbers. And as companies have become more aggressive in their accounting games, those accounting numbers become even less reliable. And as we move away from manufacturing companies, we've talked about the accounting inconsistencies that drive book value and earnings at technology companies. I know that many traditional value investors view concentration as the right thing to do, that you need to hold a small portfolio because it shows conviction. I get it. If you truly believe that a stock is undervalued and you're going to make money on it, you're saying, why would I own 15 stocks when I can own the best or the 3 best or the 5 best? I think the choice is a false one, though, because it misses the effect of uncertainty. Uncertainty about your value, uncertainty about markets correcting to them. Because even if you're right about the value that you've estimated, markets have to adjust to that value for you to make money. The more uncertain you feel about your valuation and about the market correction, the bigger your portfolio has to get. And the choice between, do you want to be concentrated and make excess returns, pick the best stocks, or diversified and be like the market, is a false one, because there are 46,000 publicly traded stocks at the start of 2025. I can own 25 of them and still pick good companies. And in fact, one of the ways to think about how much diversification is good for you, I'll turn it back to you. I'm not going to make the argument that you should have a more concentrated portfolio. But if you feel absolutely certain about your estimate of value and absolutely certain that the price will adjust to value, then you put all your money in one stock. The less certain you feel about both of those, the more diversified you should get. Finally, take away the righteousness. Nobody's entitled to a reward just because they're value investors. Invest well, do your homework. And if you get excess return, treat them as icing on the cake. And if you don't, it is how markets behave. You don't own the high ground when it comes to an investment philosophy. You can be a value investor, have respect for growth investors and traders, because they come to the market with a different philosophy doesn't mean they're wrong. Keep an open mind, because you might want to borrow some of the things they do and make yourself a better investor. So I do think that value investors, have made this defense of, hey, this is the best way to invest. And I think we need to step away from the best way. This is the way that works for you. And the fact is that you have a long history backing you, and you have some great investors whose names you can point to. The very fact that you keep talking about Warren Buffett tells you there aren't that many names, even in value investing, you can point to. But I think ultimately, when you look at, does value investing work, you can't just point to these names of success. You got to look at in the aggregate. Has value invested add value? And the evidence there is pretty weak on all of that work going into value investing actually showing up as excess returns. So in conclusion, value investing comes in lots of different forms. There are these screeners who follow the Ben Graham approach and screen for cheap companies. There are contrarian value investors who look for stocks that have dropped, but where the value still is held up. There are activist investors who try to change the way a company's run. And each approach seems to have the academic background saying this works, but in practice, there's actually surprisingly little evidence that any of these approaches create value. It's hard work. And why would it not be? Investing is one of the toughest businesses to win at. And the fact that you're a value investor doesn't take away from the toughness. I hope you found this session useful, and I thank you very much for listening.